Howdy, Jacob here. Today we're looking at Safe Bulkers, ticker symbol SB. So we have a marine transportation industry. Looks like it provides marine dry bulk transportation services. It owns and operates dry bulk vessels for transporting cargoes, primarily coal, grain, and iron ore. Incorporated in 2007, we have a $440 million market cap with a $786 million enterprise value. So a good amount of net debt in comparison to the value of the company. But a 5.1% dividend yield looks pretty great there. Between 2013 and right before COVID, we saw essentially no growth, but the business itself went a little crazy up and down, it looks like, from 187 million down to 110, back up to 198, and then explosive growth in 2021, and still increasing growth in 2022. Where the last 2 years, the return on invested capital looks pretty spectacular, but outside of the most recent 2 years, minor at best. Even haven't even produced cash earnings at some points. So it looks like their dividend hasn't historically been around for a while. They had it back in 2013, 2014, dropped to 4 cents per share in 2015, then nothing until 2022. Let's look at that net debt in relation to cash flow, or yeah, cash and cash flow. So 371 million long-term debt, down from 10 years ago, 596 million, and then 49 million cash on hand. Let's see what that is in relation to cash flow. So last Okay, so we have about 52 million, 215 million, 13 million, 19 million, 39 million, 11 million. A 5 year average, I mean, that's including a huge 215 million dollar one. Outside of that, it's probably closer to like the 20 range. And so I feel like their average free cash flow is probably more like 30, 30 million. I mean, there's some business change, or maybe, okay, I think I know what's happening here. The acquisitions are part. This happened in a previous company on this website where the capital expenditures included acquisitions, and so I presume that's the case here, because otherwise it wouldn't make sense for the capital expenditures to change so heavily. But it means use of cash flow, a little bit of acquisitions, the tiniest bit of share buybacks, a big amount of debt bought here when they had a huge excess free cash flow year. Looks like they also issued a lot of stock. We see in there, yeah. So 103 million to 114 million to 121 million shares outstanding. That's outstanding. Um, okay, so I think we can start getting into this business. I think the current payout of 34 million, I'd probably want that to be cut. I mean, their use of cash every other year is kind of volatile. So I think if they cut it to 17 million aggregate, that should be fine for the business. So I'm just going to uh, cut that in half. We have less than a 4% yield. We're looking at almost a 2.6% yield. But to me, that's more promising in the fact of their 5 year average free cash flow. And so I think halving that dividend and then keeping a roughly 2.6% yield right now seems a bit more realistic. And then as for the growth of the company, it looks like it's grown like crazy recently, but I just don't see that sustaining. I think that over the next 7 years, it might go down, then come back up to pretty much where it's at now. And then I'm going to take an average of margins here. Let's maybe do 15 and 20, and then share change. I mean, no share change estimate. So the assumptions I have here get to the stock needing to fall 46% before you get a 15% return. To me, I mean, the 34 million aggregate payout is more than their 5 year average. Yeah, their last 2 years have been pretty great, but it's just whether they can hold on to that. And in a transportation like business, I've just seen revenues and earnings and cash flow go like crazy post COVID because everyone needed stuff shipped because the way the things just changed, um, from maybe going to the store to almost everything being online. So transportation and shipping was just absolutely huge for increases. But I feel like for the next 7 years, I'm just a little hesitant on seeing much growth there. And then the dividend itself on the margin side, I think they're going to try to buy make some acquisitions outside, and then again on a 5 year average, which makes me feel more comfortable not taking into consideration the peak, not taking into considerate just the consideration of the trough, but the average of a 5 year basis, making me feel more comfortable that they might have to cut that dividend down. And then, yeah, the margins, again, I think I took an average of 5 years because I just don't see it necessarily peak, staying at that 50% margin range. So I hope everyone had enjoyed the video and has a great rest of their day. Thank you so much.